So I've invited Tori here today to help us have a healthier relationship with our business finances. And without further ado, Tori, I'd like to hand over to you.
Fabulous. Thank you so much, Julia. I'm going to share some slides, if that's okay. Julia, have I got the option to share my screen?
Oh, I think so.
Super. Let's just
Yes, you do.
Great. Let's just try that. Hopefully. So thank you so much, Julia, for inviting me to talk today with you guys about a healthy relationship with your business finances. I thought that we might just start by talking about what that healthy relationship might look like. So let's just start with what does a healthy relationship look like in general? Well, a healthy relationship starts with transparency in my book. Transparency, when we're talking about finances, really means that you need to know where to look for these numbers, and you need to have them really available to you. There has to be a transparent relationship that you have with your finances, and you're only going to have that if you are keeping timely records. And I'll bang this drum time and time again. I'm sorry, those people that have heard me speak before, I talk about this a lot, because if you're not really doing what we think of as timely in the modern day is daily bookkeeping, if you're not looking at your numbers at least weekly, but preferably daily, you've not got that transparency. So if you're still doing things on spreadsheets, if you're still using some of those older methods of accounting, it's time for you to really think seriously about moving into the digital age and getting into a cloud system like Xero, but it could also be QuickBooks or Sage. There are lots of options out there. Xero is our favorite because it's so transparent. It's so easy to see your numbers when you're using a system like Xero. So we start with transparency. You've got to have some respect for these numbers. So it's no good receiving your monthly report from your accountant and sticking it in a drawer. That's disrespectful to your numbers, and it's no way to run your business. So you do have to treat your numbers with some respect. And what goes along with that, in my view, is that you have to make sure they're right. And what I mean by that is it's not good enough to say, well, it's there or thereabouts. We'll just bung that into last month. So those kind of phrases scare accountants. It needs to be exact, and it needs to be in the right place, and it needs to be consistent. And that sort of consistency of coding and making sure you do the same things with your printing and postage in your accounts this month as you did last month, that's a way of showing your numbers some respect. And the other thing that goes along with showing respect is to set some time aside for this. So respect yourself enough as a business owner to know that running your finances is an essential part of your job. It's not something you tack on at the end. It's not something that happens after you've done delivery. You need to build it into your diary to make sure you've got a time slot every week where you're looking at your numbers. So that's the respect part. Communication. We all like to communicate in different ways. If anybody's ever done that love languages test with how does your partner communicate love to you and how do you communicate it back, it's fascinating. It really explains a whole lot about my marriage. It's wonderful. So thinking about that with your business, how do you need to have your numbers communicated to you? Everybody's different. So people like me tend to like looking at big spreadsheets full of numbers. We don't get intimidated by that, but I know lots of my clients don't like that at all. So if you're not getting your numbers communicated to you in the right way, in the way that talks to you, think about getting them as charts. Ask about, can I see this in a pictorial way? And if you like to look at trends, say, can we step back from the really nitty-gritty stuff and look at it as a bigger picture? If you've got a good accountant by your side, they'll help you to really get that communication bit right at the right time in the right method for you as a business owner. Healthy relationships need nurture. Anybody that's been in a relationship for a long time will know that doesn't just happen. You have to nurture your relationship. You have to spend a little bit of time really caring about these things. And nurture when it comes to your business finances, that's about enjoying those little incremental bits where things get better and praising yourself as a business owner when that happens. Our relationship with numbers is a funny one. People think that it's all about hard facts. The numbers they're either right or they're wrong. They tell you exactly what's going on in the business. I take a slightly different approach, and as I've got older as a business owner, I've started to be more respectful of the emotional aspect of financials in the way that I work as a business owner, but also how I talk to my clients. Emotions are a really strong part of what's going on in your relationship with your business finances. It's also really important to understand what your emotional relationship with money is overall as a person, because that very much drives how you make business decisions around financials. If anybody's read The Psychology of Money, or seen that book going around at the moment, it's a great read. It's got some really good explanations of what's going on here and the importance of being respectful of the emotional part of your relationship with money, and really starting to understand, you know, what your risk profile is, where you feel comfortable. Some of my clients need 12 months cash buffer in the bank to feel comfortable. Some of them run right on a razor edge, and that's fine for them. It doesn't worry them at all. Knowing where your risk level is very important, and a good IFA can help you with that. If you haven't done that sort of risk profiling at all, I'd really recommend reaching out and getting somebody to help you understand what your risk profile is like. It'll help you see where the worries might be in the way that you run your finances, because sometimes it's quite hard to pull that out, and that's connected in with this emotional part. And the last thing about a healthy relationship, it's based on love. I want you to love your numbers. I really enjoy the bit at the end of the month where I go through my reports and I see what's going on in my numbers and I'm looking for my trends. And it's fun, and it should be, and there should be a sense of love around doing this stuff. I know for lots of people that is not how they feel about talking to their accountant or talking about numbers at all. It's more like dread, fear, horror. The aim for this conversation is to get you to move a slot along, or wherever you are right now with how you feel about numbers, just to move a step towards love if you're not quite there yet, and to really learn how to enjoy and get something back from your relationship with your business finances. So that's kind of the scene. I'm going to just run through 5 of the numbers that I think you should be tracking. And what I've done is I've slightly avoided the absolute obvious thing. Most of you will already be aware of what your turnover figure is, what your sales figure is. We use turnover, we use revenue, and we use sales. Sorry, this is another one of those annoying things accountants do. We use lots of terminology to mean the same things. Sometimes there are little nuances between them, and we're terrible about jargon. When we've finished this talk, I'll tell you this now because I might forget to do it later. I've got a guide to understanding your financial reports. If anybody wants it, it's a freebie. I will ping it over to you. So just either let Julia or me know, and we'll email that over. And it really is a great jargon buster. I'd recommend just having it tucked away. Some people read it cover to cover because it's a really useful thing to understand, but some people keep it tucked away for next time they get a copy of their accounts, and they can just go through and say, why am I looking at this? What is this telling me? Why is it important? And that guide gives you the answers to all of this. So I'm going to skip the big obvious numbers, and I'm going to go in for 5 that I think are very, very important and you might not have thought about before. And I'm going to start with knowing your cash buffer number. It's a little bit of a funny place to start, but the reason I want to start here, the reason it's my number 1, is because businesses have to survive in order to succeed. What I mean by that is, if you run out of cash before you get where you're going, never get a chance to succeed, because your business will fail. And that comes back to this conversation about turnover being vanity, profit being sanity, and cash flow being reality. And you'll have heard this in lots of different ways, that businesses can make losses year on year on year and still be in business. We saw Amazon do that for ages and ages. They never ran out of cash. You only run out of cash once in your business, and that's when your business fails, and that's the end of it. So that's why I really have this focus on knowing what your cash buffer number is in your business. And what I mean by that is, how much cash do you need to have in the bank, accessible straight away, in order for you to feel safe? And that's an emotional question. There isn't a right or wrong answer to that. And so I'm putting that up front so you can go away after this meeting and think about how you feel around that. So to sit and listen to your gut instinct a little bit. I will give you some guidance as well. I'm an accountant, so it always does come down to some numbers, and I can say it should be around this range. But when it comes down to it, it's going to be an emotional answer to this question. But you do want to write that down and keep a track of it, because you want to make sure that if you're not there right now, you may feel that you can work towards it over the next few months, or maybe it might take 6 or 12 months to get where you want to be. And my litmus test for that is, how well do you sleep when it gets towards paying? It might be rent, it might be salaries, whatever your big bill is in your business. When that happens during the month, how well do you sleep the day before that? And the aim is to get you to, I sleep really well because I know I can always make payroll. I know I can always make the rent bill. I know I'm going to be able to pay my bounce back or CBILS loans. And some of those are really starting to come in at quite big chunks of cash now for people. And that is causing some sleepless nights for some of my clients. So cash buffer number, we used to say 3 months of running overhead in the bank will see you good. 3 months is a nice, sensible number. And this is pre-COVID times. I'm now saying to clients, let's look at 6. 6 months would be very sensible, because we now know what we didn't know 2 and a bit years ago, 2 years ago, that the world can change enormously quickly and your business might just get shut down for 6 months. And that's really not a reality that we've had to deal with in the past. It's not something we've learned from, but we have learned that now, and we do know what it looks like, and we ought to take that into consideration when we're working out what to do with our business finances. So if you can sit down and work out what your overhead run rate is, that is how much money each month your business costs to keep running, stripping out your direct costs. We're not worrying about that part. We're just talking about how much it is to, if you had to shut the doors and stop selling everything, how much to keep all of your staff employed, how much to pay your rent, how much to make sure there's ink in your printer. If you can work out that number and then times it by your 6 months, that would be a very nice place for nearly all business owners that I know to have that in a savings account as your comfort blanket. And that's really what your cash buffer number is. It's a comfort blanket. Some people are running businesses that are growing very rapidly right now. And so that cash buffer gets bigger really fast. And that's why I think it's a number that you don't just want to work out once and leave in a drawer for 2 years. You want to be revisiting that, I would say quarterly, for most of my types of businesses that I work with. So they're normally service-based businesses, maybe turning over something between 500,000 and 2 million. Those kind of businesses should be looking at this, let's say quarterly, just keeping an eye on what that number is. And then every month, just having a quick look into your savings account to make sure that you're either on the way there or that you're holding nice and steady at that point. Holding more cash than that might feel like it's not working for you. You know, the money sitting in your bank account right now is not earning you interest. So you might want to put that somewhere where it can work a little bit harder, or you might want to invest in assets with the rest of that money. But having that savings account buffer is really, really helpful. Okay, so that's my first number. My second one is your net profit percentage. So yes, it's really important to know at the end of the month, how much profit did we make? When we're talking about net profit, that's the profit after your overheads. So the profit up at the top, so sales less your cost of sales, that's your gross profit. For lots of businesses that I work with who are in the service industry, there's not a big difference between your sales figure and your gross profit figure, because you don't buy things in and sell them back out again. If you're in manufacturing, that gross profit figure is also very, very important. But for most of the businesses in this group, net profit is the one we're looking at. And I specifically have put net profit percentage, that's net profit over sales. I should have put times 100% to be accurate. So looking at a percentage is because if you are a growing business, and most of us in this community are moving our businesses forward, we want to be growing. If you're a growing business, it's really easy to fall into the trap of seeing your net profit get bigger. Good, it's a good thing to see that, but not keeping an eye on what the profit percentage is. And that can be really risky. So you may be making more money, you may be turning over more year on year, and you may be making a bit more profit year on year. But if your margin, if that percentage is getting slightly smaller because your overheads are growing a little bit faster than they should be, you can start to be creating a business that's making you less and less profit over time, because that percentage is getting smaller and smaller. So what could happen is your turnover hits something like COVID, drops right out, and your percentage margin is just not there anymore. So be really careful about that erosion of your net profit percentage. I'm expecting to see that in the next 12 months for most businesses, because overheads are going to start being impacted greatly by the cost of fuel, electricity, gas. And you might work from home and have a very efficient office and think that's not going to hurt me at all. It's going to hurt your suppliers, wherever they are, whatever they're doing, and their costs are going to go up as well. So you need to be keeping an eye on maintaining your net profit margin, maintaining that profit at all times. So don't let their increased prices start to hit your bottom line because you haven't kept an eye on your prices in the same way. So keeping an eye on this profit percentage drives quite a lot of other things in your business. It means that you have to keep an eye on your pricing and ensuring that that's not dropping out, and you need to keep an eye on your overheads as well. Okay, number 3, debtor days. This is one of my absolute favorites. So debtor days is a bit of a funny old formula. So if you haven't seen this before, it's very likely somebody's told you about debtor days before. Debtor days tells you how long it's taking your customers to pay you on average. And we do that by taking the figure debtors off your balance sheet, dividing that by your sales, and multiplying it by 365, because we're talking in days. And so what we're going to see when we do this debtor days figure is how long it's taking you to get paid. And then what we want to talk about is that going up or down? So keeping a track on that, again, on a monthly basis, starts to give you an idea of, are we moving into a problem here? Are our debtor days slowly getting bigger and bigger because we haven't been spending enough time on credit control? We've allowed some customers who used to pay really well to just maybe shave a couple of extra days. They're pushing out, and suddenly they're 60 days behind, and then they're 90 days behind. So it gives you an indication of if that's happening in your business. And it's also nice to benchmark this. So depending on your industry, some of my clients have debtor days at 3 or 4 days. They have a system in their business where they get paid pretty much as soon as they raise an invoice. Others are dealing with big corporates who have long expectations, so 60-day terms, maybe 90-day terms. I'm seeing that much less now. A lot of the bigger corporates are seeing that as just ethically not acceptable when they're working with small businesses. So if you do have that sort of business where you're working with some of the big boys, always just question if they're giving you really long terms, if they've got a special policy for small businesses. Lots of them do have a different system for SMEs than they do for other big corporates. So if you are selling into those big ones, always just question that. It doesn't have to be the case at all. If you are struggling with debtor days, if they're getting high in your business, it means that your cash is wrapped up in somebody else's bank account. It's your money. It's not in your bank account. It's not making that cash buffer for you. So you do really, really need to address it. I would highly recommend reaching out to somebody like Nikki Kinton at Confident Cashflow, who's an absolute specialist just at doing this bit. So all she does every day for clients is credit control. So that's chasing up invoices, sometimes a bit before they're due to be paid, sometimes if they've gone a little bit over, and helping small businesses to keep their cash flow going. So if debtor days is a worry for you, I would definitely recommend outsourcing that bit. It can be very awkward as a business owner if you do delivery to also be the person chasing up debts. It can be much more effective if somebody else is doing that on your behalf and following up on it as well. So number 3 on my list is debtor days. Number 4 is the current ratio. Now we're into balance sheet stuff, and a lot of my clients get a bit scared about their balance sheet. Quite confident reading a profit and loss account, turnover, cost of sales, what are my overheads? These are numbers that most business owners get quite comfortable with a little bit of guidance. Balance sheet, different kind of thing. So your balance sheet doesn't need to be scary at all. It shows you a snapshot of your business at a specific date in time. So when you're looking at your year-end accounts, the accounts that you have to file with HMRC and Companies House, you'll have a profit and loss account normally that shows you 12 months of your business. I say normally because it can vary depending on what's going on in your business, but normally 12 months on your P&L and a day in the year for your balance sheet. And it's useful just to stop and think about that. Those are two very different sorts of reports. And that's sometimes where people get a bit caught out. So your balance sheet just says for Julia's business, for example, to 31st of March, or maybe the 5th of April, so let's say 31st of March 22, what was happening on that day in Julia's business. It'll show a picture, a snapshot of what's in the bank. So talking about the cash buffer, we'll have what's in your current account and then what's in that cash buffer account. If you're really canny, you might also have a VAT account and a tax account where you're just shuffling some money aside to make your life a little bit easier. So I'll show you a snapshot of what's in there. And then it's going to show you how much money you have wrapped up in assets. So those are things like plant and machinery, or you might have a company car. So things that the business owns and they've got value, that's there at the top in your current assets. And then you come down into your liabilities. Who do you owe money to? And current liabilities, those are things that are due within the next year. We sometimes use current liabilities, another bit of accounting jargon, sorry. On your year-end accounts, it'll probably say liabilities due within the next year, due within 1 year. And this current ratio just tracks the assets, the things that you could turn into cash quickly, current assets, against current liabilities, the things that you could have called upon quickly to get paid. And the current ratio tells you, are you going to be able to do that? Very, very simple. Sometimes also called the quick ratio. And it's a very useful thing if you haven't done any balance sheet sort of numbers to track, KPIs on your balance sheet. This is where I would start. I'd pull this one out and say, let's just keep a little eye that I'm not getting into a situation where I put more money than I could, if it was called on, quickly my assets into something to pay that off with. And again, it's a sleeping well at night sort of ratio. It gives you comfort to know that it's in the right place. And if it's not in the right place, it gives you something to work on in your business. So I definitely like to have that in your basket of top 5 things to look at. And the number 5 on my list is your revenue target. So I haven't said tracking your revenue number. You should probably do that anyway. Most of you will be doing that. But your revenue target, what's your plan? Now, I put this as the last one because very often I see clients go through sort of steps of education about their business finances. The first one is to understand their P&L. The second one is to start doing that on a regular basis. Then they start to understand their balance sheet a little bit better. So they probably at that stage are receiving some reports about what's happened historically over the last quarter or over the last month. And they're getting into that sort of nice flow of financial data. The next step is let's get a budget in that we can measure against. And that starts with having a target for how much you're going to make in the year, and then splitting that down into monthly chunks. So, you know, this month, when you start your month, what's my plan for March? What do I need to make all of this other stuff we've just spoken about work? If I want to put X into my cash buffer, what does Y need to be? How much do I need to get in revenue in order to then make the right profit margin so that I can put away what I need so I can sleep well at night and feel that my business is doing well? Without a target, you've no idea if you're on track, behind, ahead, or where you're going. It's really important to set those revenue targets, and I would set them on a monthly basis, because your business may be cyclical. It may have some things that go on in your world that are related to the calendar. In my world, that's all around the tax year. So there are peaks and troughs, and in many services you get a trough in July and August when everyone's on holiday and you're not selling at that stage, a little peak in September when people come back and they have that sort of back to school, let's get stuff sorted in my business time. Some businesses, big peak in December because of Christmas. Others, it all drops off and no one does any work. So it's going to be different in every business. You, as the business owner, know your business best. So try, if in the past you've just said, I want to make £500,000 of revenue this year, I'll just chunk that into 12ths. Maybe this year, make it slightly more nuanced, knowing what your cycle looks like. Perhaps you want to look back over the last, I normally say over the last 2 years, maybe you just skip the last 2 years and go back before the COVID times and see what that peaks and troughs have looked like in the past and model on that basis. The lovely thing about setting revenue targets is you're going to get it wrong. I mean, you're never going to hit it absolutely on the nail. If you do, it's luck. It's all about putting some parameters around what's reasonable, what's going to be an acceptable thing to happen in the business, and sticking it in and seeing how it does. And next year, you can tweak the way that you write your budget based on what you've learned over time. But you can't get it wrong. You can just be closer or further away from what actually happens, and you can learn to get a little bit closer as you go. So don't worry about it having to be an exercise that takes days and days and you've got to get it right down to the penny. That's not how this stuff works at all. You just want to get something down on paper that you can track against. Ideally, if you're using Xero, I have a lot of clients that come to me have no idea about the budget manager in Xero. It's a whole section of Xero. It's not an add-on, so you don't pay extra for it. It's there, but it's quite well hidden. So you do need to just do a quick search for where that budget manager is, and you want to be populating that. So let's take Julia again as an example. She's coming up to the end of her year, 31st of March. She wants to be populating that now, so that as soon as she goes on to the 1st of April, she's got some targets to be measuring against to say, I said I was going to do this. This is what's happened at the end. How am I tracking for this year? What do I need to make 11 months to get back on track if I'm behind? Or what can I bank because I'm just a little bit further ahead than I thought I was? Get those numbers into Xero. Don't worry about it being a little bit dirty figures. It really doesn't matter. It's better to have something than nothing in that slot. So those are my big 5 numbers that I would be looking to track over the next year. Tips and tricks for the end of this tax year. So end of the tax year, 5th of April, 2022. We have got some changes coming up in the next tax year that will affect everybody on this call. And that is the 1.25% levy that's going on to national insurance and on to tax. So you're going to see this if you take dividends, that the dividend tax rate goes from 7.5%, and that's after your company's paid corporation tax. So the company pays its corporation tax, then it can provide you with a dividend, and you personally pay 7.5% on everything over the first £2,000, which has a nil rate band. So you can have £2,000 out of your company and pay no tax on it. So my first bit of advice around that is, if you weren't taking a dividend this year, if you haven't put a dividend through in this tax year, you definitely want to take your 2,000 out of the business. There's a proviso on that. You can only do that out of retained profit in your business. If you are making a loss and you haven't got any brought forward profits, you can't do that. So just make sure, talk to your accountant, make sure that you're not breaking any rules by declaring a dividend illegally. But if you have got profit in the business and you're able to do it, definitely take £2,000. It's a no-brainer. But ahead of that, you want to be having a conversation with your accountant about perhaps declaring a dividend at the 31st of March, even if that's not your year end, in order to lock that in at the lower dividend rate before the tax rate change on the 6th of April. So if you haven't looked at that, you've got a little bit of time. You can only do, again, I always say this, you can only do these calculations if your bookkeeping is up to date. So you need to make sure that you know there's profit in the business. You can only do that if your bookkeeping is up to date. Run that through and then make sure that you can declare your dividend. So that's my number one tip. My second one is if you haven't paid into your pension or you haven't used up your ISA allowance. Now this is straying over onto the IFA realm. So I won't tell you where to put your money because that's an IFA's job to do, but I can tell you do this, do put money into your pension. The younger you are and the way your pension grows is exponentially wonderful. So keep putting money into your pension if you're already doing it. And if you haven't started, do it now. There's the best time is from childhood. If you haven't done that, do it now. That's the second best time to start putting money into a pension. I've had a lot of conversations with clients very concerned about the stock market right now. I hear that. It's a scary old time out there in the world. Don't lose your ISA allowance because you're worried about putting it into stocks and shares. You can put your money into your ISA wrapper, but hold it in cash until you're ready to invest it, if that's what you want to do. So don't allow that fear to say, I'm not going to do it at all, because your ISA allowances do not roll over. If you don't use them in the year, they are gone. If you don't know about how your ISAs work, you want to talk to an IFA, or you can have a really good Google about ISAs. But the real bonus of them is that the money that goes in has already been taxed. So when you take your money out of them, that is tax-free income. And we like tax-free income. It's very, very welcome when tax rates are going up. And we're going to expect that to continue to happen. The tax position for UK taxpayers is going to get less favourable. So if you can get money out tax-free from somewhere, that's going to be a bonus for you. So definitely want to look at pensions and ISAs. And my last one is super deductions. This is part of the capital allowance regime. And your business, if it pays corporation tax, is able to claim capital allowances against your corporation tax bill. We're into the second year now. So this isn't something you've got to get done by the 5th of April. We've got another year to claim these super deductions, but you want to be planning for them. And the super deduction allows you to claim 130% of the cost of those assets that fall under the super deduction regime. So those are things like plant and machinery. For lots of service-based industries, that's stuff like buying a new laptop, buying printers, that kind of stuff, where you used to be able to claim 100% of the cost against your corporation tax, or your profit for corporation tax. For the next 12 months, you can claim 130% of that. So it helps to bring your corporation tax bill down. I have got a quick guide of all the things that fall into super deductions because it's quite complicated. Capital allowances have lots of ifs and buts, and yes, you could do that, but not in this particular case. So I'll send that out to anybody that wants to know a bit more about super deductions, and that can help to bring your corporation tax bill down. I don't know how we're doing on time, Julia, but I'm done.
Really looking forward to the supporting guides, Tori, to send out to people. I think they sound immensely valuable. So thank you so much for in advance for sharing those. Thank you.